program that we're hearing about from Mr. Biden, and et cetera. How does all this affect our clients and our planning opportunities moving forward? We'd love to hear from you. So without further ado, I will again allow Dan to take hosting abilities and give him the ability to share the screen.
Share screen, okay.
Yeah, we're pretty excited to hear from you. Give us a second here.
Okay, we'll share screen here. Okay, there is my screen, and then I will make it big. All right, can everybody see that?
All right, why don't you try that one more time, Dan? We can't see it.
Oh, okay. Let me go back and hit escape, because I'm seeing it, but you guys aren't. Okay. Share screen. Green button at the bottom.
Touchdown. There you go.
Do you see it?
As a regular millennial. Good job.
All right. Now I've got to find it. It just disappeared from my own screen. Are you guys looking at it?
Yeah, well, we can see where the Zoom thing.
Hang on. PowerPoint. There. See that?
Yes.
Okay.
Yes.
Let me make it big. We there?
Yes.
Yeah, okay. I see heads nodding. All right. Thank you. Thank you for the introduction, Braxton. I appreciate it. I'm also a member of the Financial Planning Association, but of Illinois. And now that I bought a home down here in December, I'd love to join your group as well, if I can at some point, but I am a member. Braxton's going like this. I am currently studying for the CFP exam for later this year. I'm taking the Bryant course, so I think it's 5 or 6 chapters, and I'm woefully behind in my studying. And I'm not doing it because I want more letters behind my name. I already have quite a few already. But I'm doing a career pivot right now, everyone, and I'm moving from the CPA world, where I've also practiced for a bit of my career as an attorney, into financial planning. And I joined Wintrust Wealth Management a year and a half ago, and I guess the best description of what I do is wealth strategy with a focus on taxes for our clients. Those of you that aren't familiar with Wintrust, we are growing. We've grown from $35 billion bank to a $45 billion bank in just the last year since COVID began. And we have an office, which I was in today, on Tamiami Trail, just about, I don't know, maybe a mile south of the Northern Trust office, if you know where that is on Tamiami. So we have a very nice office here, and we're expanding by leaps and bounds. But enough about that. My career, I'm a tax guy, and that's how I'm approaching it. This presentation, it's focused on the tax aspects of the last several acts and the one to come, that I'll tell you what I think is going to happen. I was a partner at KPMG for 21 years since I took early retirement, and I'm making this career pivot here. I was the managing partner of KPMG's Chicago practice for 10 years, which was 350 people in Milwaukee. And I also recently have been chairman of the board of the Illinois CPA Society. I'm on the board of the AICPA, our national body, and I'm president of a different group called the AAA-CPA, which is the American Academy of Attorneys and CPAs. I'm president of the Illinois chapter of that. And I need to look into whether there's a Florida chapter so I can join. What we're going to talk about today, I'm going to go quickly. We're going to look back on 2020's legislation. I'm not going to rehash the CARES Act, which happened exactly a year ago. But we are going to take a look at the December 27th Act, the CAA that Braxton mentioned earlier, that we weren't sure. It passed sort of quietly right after Christmas. People weren't sure whether President Trump would actually sign the plan. He balked for a few days, but that got signed. Hasn't been talked about as much, but that's in effect right now. And there are provisions in that have been extended from the CARES Act into 2021. There's a lot of implications on 2020. So that's very relevant right now. And that was only 2.5 months ago that got passed. And then last Thursday, President Biden's American Rescue Plan was passed a day earlier than he said he was going to sign it. Ended up signing it on the 11th. And he also announced back in January, and just starting earlier this week, you'll see certain press releases and mentions of it by the White House on what's coming. And that's the Biden Build Back Better recovery plan. That will happen later this year, and I'll talk about what I think the timing will be and what's going to be in that plan. That's the plan where all the tax increases are going to hit our clients. And finally, I've got at the end of this tax planning strategies tech checklist, things that I would recommend in bullet point fashion that you may want to keep around as we move through the year and move to a period of possibly a January 1, 2022 effective date for the tax increases that are on the horizon. We shall see. And I'm going to skip the Illinois portion because I don't think I have anybody here from Illinois, but it went over well 2 weeks ago with the Illinois chapter of the Financial Planning Association. So let me just jump right into it. Looking back on legislation in 2020, wow. And now it's almost $5 trillion of coronavirus legislation after the American Rescue Act was passed last week. And if you'll recall, we had the Family First Coronavirus Response Act. There actually was an act before that was much smaller, but that was the first one with real implications. And then we had the CARES Act. And that was monumental. That will go down in history. I've been doing this for 40 years, and that was one of the biggest acts I've seen since Ronald Reagan and the Act of 1986. And then we had an extension of the CARES Act and several provisions extending the PPP program, the Paycheck Protection Program. And finally, the CAA, the Consolidated Appropriations Act, which we said was passed on December 27th. And we're still digesting that. And then along comes the American Rescue Plan Act that was just passed. So that's a lot to talk about. I'll go quickly. We've got another 40 minutes, so I'll go quickly. I'll just leave it at that. The Consolidated Appropriations Act. Again, this was passed December 27th, and it's really a combination of three separate tax acts, $2.4 trillion. And within that $2.4 trillion budget, they also allowed for $1.9 trillion of net spending that ended up resulting in the American Rescue Plan Act, in the budget that was passed early. That was in January that they passed the budget and allowed for $1.9 trillion on top of this $2.4 trillion that from December. CAA, again, briefly, it's been around for a few months, so I'm not going to belabor it. It had $245 billion of additional PPP loans within the $900 billion of COVID-19 relief. The extender package you could see down here and the relief provisions. So a lot of money went into relief. Let's just talk about the extension of the PPP program after the CARES Act and how it changed. It lowered the size of eligible businesses that qualify for PPP. And let me back up. Why is PPP so important? Well, these are loans that end up being forgiven, and the forgiveness is tax-free. So they end up being grants. So that's absolutely huge. That's the best of all worlds. You get a grant and it's tax-free from the government. So a little bit of the parameters on what it takes to qualify under the CAA version of the PPP program: 300 employees, down from 500 under CARES, 25% decline in gross receipts. And a maximum loan size has declined from 10 million under the CARES Act to 2 million. So more targeting smaller companies. And if you remember back in last April, there was a big hullabaloo about public companies getting loans, and some of them even turned back their loans. Some of them for very large public companies got PPP loans. Well, now they're ineligible. They're no longer able to get these loans. And there was also controversy over tax-exempt organizations. Many were not allowed to get PPP loans. That was expanded on the CAA legislation that's here. And finally, we have Amy Klobuchar, who is a candidate for president and a senator from Minnesota. She is responsible for additional aid that went to to the food service industry, to restaurants. Anyone with a code that starts with 72, which is the restaurant industry, gets a little bit of extra loan amount, and which ends up being a grant. So thank you to Amy Klobuchar for that. Another big issue, huge issue that consumed many of us for the second half of 2020 was whether these loans would be forgiven. When this CARES Act was passed, Congress said, we want this to be tax-free. But then Secretary Stephen Mnuchin came along about May and said, wait a second, the tax law says that, and he was correct, technically. The tax law says, no, yes, if that's tax-exempt income to you, then the underlying expenses that generated that tax-exempt income, which was payroll, again, payroll protection program, payroll, rent, and certain identified expenses that you had to incur and report in order to get that loan and that loan forgiven, well, that's non-deductible. Well, when you made the underlying expenses non-deductible, on top of the fact that you got tax-exempt income, it basically is a wash. It washed out the intent of Congress. They came through under the CAA, clarified that point, and said, no, IRS and Treasury, what we intended was this. So you get the expenses and you get the tax-exempt income, which is what they intended. Also, there was a lot of paperwork, and there still is. It got even worse under the new version of PPP. The Small Business Administration, which runs it, made it very complicated. So the good news is for small businesses with loans of under $150,000, there's a very simplified loan forgiveness form, as opposed to all the hoops that those small employers had to jump through before. And basically because the small employers don't have the firepower within their finance department in order to fill out the forms, or it was quite difficult for them. So they simplified that process. And then you'll see some other changes from the CARES Act that went through in the CAA as well. All right. The deadline is coming up now. So right now, this current program that we're sitting in, and what is today, the 19th? I can't see my watch. I think it's the 18th. Yesterday was St. Patrick's Day. I know that's always the 17th because I'm Irish. 18th. Today's the 18th. So we have I'm an accountant. It says 13 days from now that the program sunsets. All right. It's supposed to end on March 31st. But you'll see in the second bullet point that I added the other day, by a vote of 415 to 3, the House has now passed a bill to extend it to May 31st. So fear not, I believe that will happen. It should go through the Senate, given the bipartisan support that has come to promote this initiative. And there's a reason why. The SBA made it incredibly difficult this time around with additional layers of security. So for good measure, there was a lot of fraud involved in the first round. So they added additional security. The problem is it really slowed down the program for the people applying for it too. So they need to extend the deadline. Okay, here's the hidden gem in this. And there's more funding for the employee retention credit that comes through the American Rescue Act as well, that you'll see in a bit. I call this the hidden gem because this was in the CARES Act, but people didn't really talk about it very much. Why? Because under the CARES Act, you either got the PPP loans, which ended up being a grant, a tax-free grant, or you could do this. You couldn't do both, all right? And let me admit somebody. There you go. You couldn't do both. Now you can. Under the CAA, the Consolidated Appropriations Act, you can have both your cake and eat it too. You can have a PPP loan and an ERC, Employee Retention Credit. There are strings attached. You just can't use the same payroll to take advantage of both programs. But let me tell you a little bit about the program and you'll see what I mean. This gives you a credit against your payroll taxes. And the entire credit against payroll taxes in 2020 under the CARES Act was $5,000 per employee. All right, you could take 100 employees and take $5,000 per employee and take it directly against your quarterly payroll taxes. You didn't have to apply. You didn't have to fill out a form and send it in. You could if you didn't have enough payroll tax to offset. There's also a form that you can get an actual refund of this credit. But you could get $5,000 back per employee against payroll taxes, okay? And you don't have to go through the whole process of PPP. What the CAA did was extended this and expanded it, the ERC, the Employee Retention Credit. Again, it's a credit to retain employees, exactly what it sounds like, through June 30th. And wait a minute, and you'll see that this got extended again through December 31st under the American Rescue Act. But under CAA, which we're talking now, it extended through June 30th, and it increased the amount of credit from $5,000 per employee to $14,000 per employee, and increased the number of employees eligible from 100 to 500. So if you have 500 employees times $14,000, where's my calculator? That's a big number. That's a big credit, right? I don't have it in front of me, but that's a big credit. And again, you're not applying for it. You're putting it against your payroll taxes. So you're just taking it back. And again, there's a form that if you don't have enough payroll taxes to offset, and you're coming up with even more than you're paying, then there is a form that you can file with the IRS and actually get a cash check or probably an automatic deposit of the amount of credit you're due. And here are some other, on the slide, some other details of this. Obviously, you have to be impacted by COVID, right? But it reduced the amount, the threshold from a decline of 50% down to 20% that you were affected by COVID. So not so bad. And there are some other rules for employees that are new employers that weren't even in existence in 2019 can now claim the credit, which they couldn't under the CARES Act. So now you kind of see why I call this one a hidden gem in CAA. It's a big benefit. And the very last one I put in italics because I just put it in the other day. The American Rescue Plan Act from last Thursday extended the program now through the end of the year. So it's $7,000 per quarter. And now you get 4 quarters in 2021. So now it becomes $28,000 of credit times 500 employees. That's a big number. However you look at it, that's a big number. So I'm trying to find this here. Okay, we just went over this. Shuttered venue operators grants, new. This is brand new. This was not in the CARES Act. Theaters, movies. In Chicago, we have a live comedy theater called the Second City, where a lot of the actors at Saturday Night Live came out of. Those are all shuttered and shut down completely. Symphonies, operas, a lot of performing arts here in Naples itself. So they have a really good lobby in Washington. That's all I have to say, because they got 15. I'm not saying it's not deserved, but a lot of industries wanted money out of in the CAA and later in the American Rescue Plan Act. Of course, there's lobbyists come in from all directions, and they got $15 billion for their industry. So if you're a shuttered venue operator and you're one of the eligible businesses listed here, and you must have been in operation on February 29th, 2020, then you can take up to a maximum, you can get a tax-free grant. Again, this is tax-free of up to $10 million. $10 million per venue. So congratulations to that industry. They did a nice job of lobbying. Out of the CARES Act, there was another grant program in addition to PPP called the EIDL program, Economic Injury Disaster Loans. And these were $10,000 grants. Again, tax-free. Again, had quite a few adjustments or clarifications by the SBA and Congress following the original CARES Act of how this works. Later, after the $10,000 grant came in, it was proposed that, well, you only get $1,000 per employee. So if you were a single member LLC, Schedule C, you only get $1,000. You didn't get $10,000. That wasn't in the original act. That came later in the FAQs. But it's a loan. This is a loan. So the $1,000 is a tax-free grant. But on top of that, you can get a loan. Now, it's a true loan. The loan on top of the grant, the $10,000, up to $10,000 grant, is a 3.75% loan handled by the SBA. It recently was just extended the due date. And you'll see the bullet points at the bottom, March 12th. So that was a week ago. I added this bullet point because that's when the law changed, or a new announcement came out from the FBA deferring the interest on these loans. So it's for, again, businesses with less than 300 employees now under the CAA. And under the CAA, they changed the program from the CARES Act. Now the business has to be located in a low-income community. And the devil's in the details. I can't get into the details right now. We don't have time as to what that is, but it's identified in a low-income community, which is a defined term. Other provisions, and I'm going to go fast. The FFCRA, the Family First Act, that we talked about in the very first slide in our historical review. There are other provisions in the CAA Act that extended that through March 31, 2021, which is coming up. Unemployment benefits. Remember that President Biden wanted to sign this bill, had to sign this bill before March 14th. Why March 14th? We heard that date over and over again. That's when the unemployment benefits ran out from the CAA. They only extended federal unemployment benefits in addition to state unemployment benefits. $300 per week from December 26th through March 14th was in the CAA. Now you'll see what the American Rescue Plan Act did in extending that coming up. But that was why you heard March 14th all the time as the Democrats' deadline for getting this thing passed. They wanted the benefits not to miss a beat. Disaster zone relief. There are a lot of provisions in the CAA that have to do with non-COVID-19 disaster loan relief. There's a long list. So if you got hit by a hurricane or a tornado or flooding or forest fires in California, there's additional relief in this act for those people and those hurt by it. And then also extension of CARES Act provisions. You can see a number of them here. New markets tax credits, empowerment zones, WOTC, which stands for work opportunity credits, etc. There. Other CAA provisions. I had been saving this cartoon for a long time because, like I said, I'm a certified public accountant. I don't normally mention it at cocktail parties. People look kind of down on me. But I'm a closet CPA. And so I kept this little thing for me in the back of my phone for a long time. It says out to a tax deductible lunch. Well, I kept it because this came out in 2017 when the Trump Tax Act got passed, which obviously all the tax cuts that accompanied that. And lunches as part of the act were no longer fully tax deductible. They're only 50% tax deductible. So I thought this cartoon was funny, not because it shows an accountant being kind of nerdy, but because it's wrong. It was wrong. You're not out to a tax deductible lunch, you're out to a 50% tax deductible lunch. Well, why is this now correct? Why did the CAA make this cartoon correct? At least for this year and next year. Because deductible meals, if you have it in a restaurant, this is to help the restaurant industry. That's the argument, at least. It was it's one of the provisions that former President Trump really pushed to. He wanted this. Now he can deduct all those lunches at Mar-a-Lago, and that makes him happy. All right, if it's restaurant provided, so it helps their restaurants. Individual provisions, real briefly. Remember, in the first week of January, if you've got college kids that just graduated from college, other individuals below a certain threshold, they were able to get $600 refundable recovery rebate checks that they're now going to report on their 2020 tax returns. And if they didn't get enough, they can get additional credit on this year's taxes that you're preparing right now. Charitable contributions, the new above the line provision that came in the CARES Act, $300, that's now extended through 2021 because of CAA. That's great. CARES Act never came out and said that married couples get $600, but they do. And the CAA clarified that retroactively. So in 2020, a married couple can take a $600 tax deduction. So if you're also doing taxes for your clients and you don't see the $600 on page one, well, what used to be page one, what I call above the line, deduction, ask them about it, because maybe they did give $600 to charity. It had to be cash. All right, let's keep going. A few other provisions, medical expense deductions. This one permanently, the one permanent change in CAA from the carryover from the CARES Act, permanently set medical expense deductions, unreimbursed medical expense deductions at 7.5% of AGI. Previously, it was 10%. Again, if you got a good computer, any tax software will compute this correctly. But the key is to put in the right number. And if you don't realize that your client may have if they have $100,000 of AGI and they had over $7,500 of unreimbursed medical expenses, they itemize, they have an additional deduction now. And some others. Here's one at the bottom that may apply to someone. $750,000 of discharge of indebtedness on your personal residence, your home. Let's say it can't be, you can't declare bankruptcy and take advantage of this position or this provision. You have to, it has to be a negotiated settlement with your bank, with your lender. So it was previously $2 million under the CARES Act. That got extended for another 5 years. So you have a client that's able to negotiate down his mortgage with whoever lent him the money, his mortgage lender, and he was forgiven $750,000 on that mortgage. Normally that's COD income. What is COD income? Cancellation of indebtedness. That's taxable income. Anytime you have COD income, unless you're bankrupt, under Section 108, that's an exception to the taxable rule. It's taxable. But this provision in CAA, and started with the CARES Act, and for 5 more years, that's going to be tax-free to those individuals that get their mortgages adjusted. So anyway, let's take a look. This is one slide, and then I'm going to jump into the American Rescue Plan Act. But so what did Biden announce when he became president? Before or the second week of January, what did he announce? He announced he was going to pursue the American Rescue Plan Act, which he did, passed last Thursday. But he also announced, and I have a quote here, on January 14th, that he will announce in February, and it didn't happen in February, but he said it would happen in February, something called his Build Back Better Recovery Plan. And I'm going to talk about that in a bit. They are starting to see information on that come out now, and they're working on that, and you're going to see that very soon. So let's talk about the American Rescue Plan Act before we talk about the future and Build Back Better. So what happened last Thursday? Well, another $1.9 trillion of COVID-19 relief was passed, and this is where the money goes. And you can see all the different categories. The big one at the bottom, the $1,400 impact payments, the refundable rebate credit amounts that are going to hit bank accounts any day now. You see state and local government aid, you see going up the line, and I'll be going through these things in a bit, but this is kind of the spectrum of where the $1.9 trillion went. So let's just talk about the PPP program for again. Started with the CARES Act, continued with CAA, here we are again with the American Rescue Plan Act, but it worked. All right, it worked. I love to point to something that our government does and say they did a good thing, and this is a good thing what they did with PPP and making these loans, if you will, forgivable and non-taxable. So the American Rescue Plan Act extended the PPP program and expanded it eligibility to nonprofit entities. I'm the chairman of the Finance Committee of the oldest charity in Chicago. It started before the Civil War in the 1850s. In our charity, we're over $100 million now annual budget. So good-sized charity. And does wonderful, after-school programs, drug rehabilitation, anti-abuse programs, and also anti-violence programs in the city of Chicago. Well, they couldn't get a PPP loan program because they had 500 or more employees. Not at a physical location, but throughout the Chicagoland, we have after-school centers, we have medical clinics, we have teaching facilities, And not one of them had over 500, but if you added all the employees together, it's about 1,200 employees. They couldn't get a PPP loan. They can now because of the American Rescue Plan Act. They're applying the exception that also applied to restaurants under the CARES Act now to tax-exempt entities, which we think is great because now they can get some of this and they're a tax-exempt entity. It'll be put to good use. And the American Rescue Plan Act also allocated another $7.25 billion to the funding of PPP. I said earlier it runs out in 13 days from today, and the House passed a bill March 16th, a couple days ago, 415 to 3. So I venture to guess that this will be extended through May 31st. Okay. Restaurant Revitalization Fund Grants. This is different than Shuttered Venue that came through CAA for the first time. This is another new program. This is now as part of the American Rescue Plan Act, and it's for restaurants, $28.6 billion of grants, tax-free grants. I have that in the bottom bullet point here where I say it's non-taxable in a manner similar to the PPP loan program. It'll apply to restaurants, bars, food trucks, caterers. Up the street from me, I'm a frequent customer at a place called Celebration Park. I love their food trucks. I love sitting by the water, and I love the bar there. So I go over there frequently because I can ride my bike from my house here over to Celebration Park. And those are food trucks. They now can partake in this program. The grants from this fund limited to $10 million per entity and eliminate a limitation of $5 million per physical location. I can't imagine any single food truck's going to get $5 million, but you've got to go through the rules to determine what they qualify for. Employee retention credit. I said earlier this was the hidden gem, didn't I? Well, this was now extended through the end of the year. How wonderful is that? $7,000 per quarter, 500 employees. This is a huge number, and they can take advantage of all the other benefits of PPP. You just can't use the same employee payroll numbers to qualify for both. All right? The devil's in the details. If you get into the details, you can always call me. I can walk you through it, but it's actually a little bit of a convoluted and complicated process to apply for PPP and go through this. So you really need a good accountant, a good CPA to work through the numbers. Expanding the ERC to startup businesses, that's another real positive that was in here. FFCRA credits, again, that's the Family First Act. More extension for this one to September 30th. So again, many of these programs, not all, some are new, but many of them are just extensions of prior legislation, and they're being extended because they worked. And compensation deduction for publicly traded companies. We tax people, call that code section 162M. That's the $1 million limitation on the 5 highest compensated employees, and they expanded that rule. So more publicly traded companies will be hit by that rule. It's now 5 individuals in addition to the CFO and CEO. It used to be 3, and now it's 5 in addition. Oh, and remember, the $15 an hour wage was dropped in the Senate. You've seen a lot of discussion about that. Bernie Sanders really fought hard for that. Stay tuned, but that could not make it through reconciliation in the Senate. It didn't qualify as part of the federal budget. It was a separate law. It didn't qualify under a financial, it didn't have the financial characteristics required for reconciliation. It was different. Individual rebates, and now I'm going to go through all the individual parts of this, and I think I'm staying pretty much on task here, time-wise. $1,400 rebates going out very soon. It means a married couple can get $2,800. It's an advance payment. Now, the new ones that are coming out this month go against your 21 tax return, so a year from now. Last year's payments, which were $600 and $1,200, the 600 came through in January. Those going on 2020 tax returns that accountants and you that are doing your tax returns now, those are refundable credits on 2020. This under this act of American Rescue Plan will go to 2021, a year from now. You're allowed to use your 2019 return, though generally, but if your 2020 return has already been processed, you can use that as well. There was a lot of confusion early on. A lot of people didn't get their credits. If they filed a paper return in 2019, it got lost in a semi-trailer, tractor-trailer truck in either Kansas City or Cincinnati. So the IRS is still digging through the COVID effects of sending their employees home. So they're giving you a lot of flexibility here on what tax return is sitting in the IRS's computer. And the phase-outs are a little bit more severe this time around, however, starting at $75,000 for individuals and $150,000 per couple. It phases out pretty quickly where people won't get the credit. Good. Child care tax credits. There's a lot of child care implications in the American Rescue Plan. A favorite of President Biden is taking care of the children, and I don't disagree with him. So expanding the child care credits, these are significant credits. It's increasing it to $3,000 per child, but $3,600 if they're under 6, and it increases the maximum age to take the credit to 17. Again, if you have clients that fall under the phase-out point of $150,000 and they're not doing this, it's a topic to bring up because they're missing an opportunity. And in a new twist, the Treasury Department is also going to make 50% advance payment against this credit on July 1, and then they'll true up at the end of the year on next year's tax return. Earned income tax credits, this is what I was interviewed for, a newspaper in Chicago about 2 hours ago. There are a lot of changes in this act, but they all apply for 2021, basically. There was one significant change in the CAA that applies to 2020 on earned income tax credits. Again, for lower income individuals, it phases out as they become more wealthy. So odds are you don't have that many clients that qualify for these, but I want to make you aware of them. These were all expanded under American Rescue Plan and will apply to next year. Again, child and dependent care credits were expanded. Significant numbers, $4,000 for one individual and $8,000 for two or more that you're taking care of. Unemployment insurance, remember this number was $400 when it came out of the House of Representatives. The Senate reduced it to $300 a week, mostly to satisfy some moderate Democratic senators. And these federal unemployment benefits that piggyback off the state unemployment benefits now will be extended through September 6th. And that was from March 14th, the deadline we talked about previously. Now that will be extended through September 6th. And in a surprise that we didn't see coming, and a good surprise for those that received these benefits, the first $10,200 will be tax-free. And that applies retroactively to 2020. So in this act that was passed last Thursday, there's a retroactive position or provision that says that the first $10,200 in benefits are tax-free for your households if you make less than $150,000 a year. So a big benefit there. Now, what do you do if you already filed your tax return? Before last Thursday, a month before, the IRS started accepting e-file tax returns. And some people have already filed their returns and did not take this benefit. The IRS is saying, hold on a minute, before you rush out and file an amended tax return, correcting the IRS, if you will, retroactively, or correcting your return, to take this $10,200 out of taxable income, just wait a minute. We're going to come out with some pronouncements going forward, and we're going to figure out how to handle this. So don't have your clients run out right away and amend tax returns. By the way, both spouses get 10-2, so that's $20,400 of tax-free income potentially to your clients. That's a pretty big number. And in a really interesting one, this also slipped in. Didn't see this one coming. Student loan forgiveness. That's not in the act. That's not in the American Rescue Plan Act. there's no student loan forgiveness. That ended after the CARES Act at 12/31/2020. But they did put a provision in here that said, but if there is future tax loan forgiveness between 2021 and 2025, that will be tax-free. Okay? The amount that we forgive, again, I talked about it earlier. When you get COD income, cancellation of indebtedness income is taxable, unless you're bankrupt and fall under an exception. That's taxable income. Well, what they're saying here is, if in the future we forgive student loan debt, it'll be tax-free. Because otherwise, if somebody got $50,000 forgiven, they just now had to report in a doctor, let's say, went through medical school, runs up $1 million of student loan debt, and it may be one of your clients or a son or daughter of one of your clients, and they're sitting on a mountain of debt, and the $50,000 gets forgiven. Well, now they have to pick up the $50,000 in income, right? So now they're paying whatever tax on top of that, federal and state, at their marginal rate on the $50,000. Well, this provision says they don't have to do that, but it didn't forgive the debt. So what does that tell you that's coming? The final bullet point that I just added. Biden supports $10,000 of forgiveness. He does not agree with Bernie Sanders and Chuck Schumer, who want $50,000 of debt forgiven. Stay tuned. You're going to see a little bit of infighting within the Democratic Party itself on what the right number is. But that's coming. That's coming. And let's continue now. We're on the last lap, folks. What's going to happen in 2021, the current year? Well, Biden said it himself. He's calling it the Biden Build Back Better Recovery Plan. He likes his B's, BBBB, recovery plan. And, he said that he would come out in February and with the details. Hasn't happened yet. We're almost at the end of March. They did come out at the end of February and say, the White House did, well, we're going to wait until the American Rescue Act gets passed now before we move forward with the next act. Well, this next act is where the tax increases are going to come in. So they are slowly leaking information to the public, through the press, on what they're going to include. But what do we anticipate is going to be in here? This is what I'm going to go over next. Before I do that, what's the timing on this thing? And can it be retroactive? The very last slide, I'm going to answer the retroactive question. But what do I think the timing is? I think the timing, they're going to start lobbying for this probably in April. They're going to go through it this summer, going back and forth with both moderate Democrats in the Senate, conservative Republicans. All right, the Republicans aren't going to go for this. So there's going to be a lot of negotiating going on what I'm going to talk about next. Then we're going to hit October 1. What's October 1? It's the first day of the federal government's fiscal year. The government is on a September 30th year end. They've already done their budget for the fiscal year ended 9/30/2021. That's where we got the $1.9 trillion from, that they ran through reconciliation, and they didn't need 60 votes in the Senate. They only needed 50 because they came in right at $1.9 trillion, which was the amount which was in our annual fiscal budget. Well, they get another bite at the apple next year. Every year there's a new fiscal budget. They're going to build into that budget in October whatever net amount of that's out of pocket that's going to be a depletion to the Treasury from whatever gets passed. It's also an infrastructure bill, by the way. There's going to be a lot spent on infrastructure. So it could end up, even with the tax increases, costing. And that's why I think it'll be in the fourth calendar quarter, because it'll be built in part of the whole, to avoid the filibuster in the Senate and go through reconciliation. I think they're going to combine it all and do that in October and in the fourth quarter. What are they going to do? I think for sure we're going to see top rates go from 37 to 39.6, over 400,000. This is no surprise to you. You've seen it since last fall, since the campaign. This was part of the Biden campaign pledge. The top corporate rate's going to go from 21 to 28. That's a 33.33% increase. So it's going to go 21 to 28. But get this, for large corporations with over 100 million in book income, they're going to bring back what's called the alternative minimum tax on corporations. That went away after the 2017 Tax Act. The Trump administration did away with the AMT for corporations. It's going to come back. What it's going to do, it's going to bite a company like Amazon, which pays a very low tax rate. if you looked at redid their 2019 tax return for Amazon, they would have paid 1.3 billion more in taxes just with this one provision alone on the 15% AMT. So interesting, right? Janet Yellen said during her confirmation hearings that she's fully supportive of the 28% corporate rate. Again, one side of the economists. I've never seen two economists agree on the same thing in my life. Every economist has a different idea of what's going to happen and a different model. But the economists will argue that it would make the U.S. economy less competitive on a global stage. Therefore, they may not, you're going to see a lot of discussion around the corporate tax rate. But individuals, they don't think that they're going to pay more for product that comes into the retail stores. So they like to see corporations get pursued for more taxes. Unfortunately, that's an expense of the corporation, which is most likely a big public company that's going to pass that on to consumers. Itemized deductions. This one you've probably heard about before and haven't thought about it lately. They're going to cap all itemized deductions at 28% effective benefit. What does that mean? That means if your client, a wealthy individual, contributes $100,000 a year to charity. Today they get top bracket benefit of 37%, right? Simple math. Well, the bracket's going to go up to 39.6. That's great. But under this plan, they'll only get a $28,000 benefit on a $100,000 charitable contribution because this new law is going to cap all bracket benefits for itemized deductions at 28%. In addition to that, there's another limitation they're going to put on top of that called the PEAS limitation that existed pre-2018. The Trump administration did away with PEAS, but now it's going to come back, and it's 3% of adjusted gross income. There are some limitations in there. I'm not going to go into the details, but it's another limitation on itemized deductions. Let's talk about retirement plan contributions and effective rates. Today, you make a contribution to an IRA or your 401k plan or your SEP plan, or you're self-employed as a wealth advisor and you have a defined benefit plan and you're putting away a lot of money. I've seen certain doctors put as much away with an actuarial plan of $400,000 a year. And what do you get? You get today the top marginal tax rate on that deduction for your contribution employment plan. They're going to do away with deductions for retirement plans. They're going to make it a credit, a 26% refundable credit. So now if you put in, I'll use a round number of $10,000 instead of $26,000 if you're over age 55, in your IRA or 401k plan. Let's just say $10,000. Instead of a 37% bracket person getting a 37 cent on the dollar benefit for that contribution to his or her retirement plan, he or she is now going to get 26%. So not the tax bracket, it's going to be capped at 26%, just like itemized deductions are capped at 28%. This will change a lot of your planning models. When you calculate, future income and the tax effect on future income, retirement plan contributions can be limited. Why are they doing it? I'm not arguing with this. Why are they doing it? Somebody in a 10% bracket today is not incented to make a retirement plan contribution like someone in a 37% bracket. It's simple math. They get 10 cents on the dollar versus someone in the highest bracket gets 37, or in the future 39.6. So this levels the playing field in society. For all people get the same benefit, it'll come back as a credit. Let's talk about the donut hole in payroll taxes for a second. I don't have the word donut hole here, but it's in all my articles. I usually publish an article a month on these sorts of things, and one of my headlines was "Donut Hole is back." Social Security taxes. You pay 6.2% today, up to 142.6. One of you is going to correct me on that. Last year was 137. So in 20 21, you pay FICA taxes on your first $143,000 of income. And that goes away. Not the Medicare tax piece, but the 6.2% basic FICA tax. Self-employed individuals pay 12.4, don't they? They pay both sides. Some of you are self-employed. Some of you are single member LLCs, I would venture a guess, that report your business on a Schedule C, don't you? And I've done thousands of your tax returns over the years. I know how it works. So you're paying 12.4% SE tax. So if you net $100,000, you're paying another 12.4 to the government. But it goes away above $143,000. Well, President Biden proposes is that it goes away, but only for a period of time. Hence the donut hole comment. It goes away until you hit $400,000 again, and then it re-engages. So here's my example, and I've had these sorts of taxpayers before. $1 million a year doctor, surgeon, partner in a law firm, an accounting firm, okay? And they're making $1 million a year, and they're paying 12.4% on self-employment tax on what they bring in on their Schedule C that they have set up as a limited liability or professional liability company. Well, they are now going to pay 12.4% on $600,000, million minus the 400 where it kicks back in, and that's $72,000. That's an additional $72,000 for that person making $1 million on top of the new tax increase to 39.6, on top of capital gains rates if they're over $1 million, which is coming up next, that just went to 39.6. On top of all the other tax increases, the limitation on their itemized deductions at 28%, and the retirement plan contribution that they make. Unless it's a defined benefit plan, it's in the six figures. Well, that just got capped at 26% instead of 39.6. So you can see how taxes are going to go up significantly for people making over 400 grand, and certainly over $1 million, which is the next bullet point on capital gains. They're talking about doing away with that and making it no longer a preference item. Capital gains, qualifying dividends above $1 million will be taxed at ordinary rates. What do I think is going to happen? I think they're going to negotiate this one and maybe bring it to 28%, where it used to be 20 years ago. Remember, capital gains were 26, 28% in the 90s? That...
I gotta have you back up. Capital gains taxed at ordinary income rates is the proposal.
Yes, for over $1 million. For over $1 million. All right? So you're not going to be taxed at 20% plus 3.8% for you tax geeks out there. There's an additional tax called the Obamacare tax. That it's called the NII tax, net investment income. It's 3.8%, but on top of 20% for investment income. So today, if you have a long-term capital gain and your income's over $500,000, if it's below $500,000, you're paying 15% today. If you're over $500,000, you're paying 20%. On top of that, you pay an additional 3.8. That 20% is going to go to 39.6, Braxton. It's going to go up to the top ordinary tax rate for those over $1 million, and you're going to add another 3.8 on top of that. So now you are in 39.6 plus 3.8. Now you're in a 43% tax bracket. And if your client is in a state, a high tax state like California at 13.3, California, or if you're in New York, Hawaii just proposed an 18% top tax bracket. So if you're in one of those states and your capital gains, and let's say you sell your business, your family farm, whoa, you're paying well over 50% tax on that gain because you inherited a family business with zero tax basis or a farm or something else. Or you bought Microsoft stock in the 1990s or Apple in 2000, right? I'm going to go quickly. I'm sorry, guys, I'm going over. But I think this stuff's important. I love it. 199A, pass-through deduction, that'll go away. That came into play in 2018. That'll go away for individuals over 400 grand. Like-kind exchanges of real estate For a business like-kind exchange, it still applies today. That'll go away. So if your client's considering a like-kind exchange of real estate, do it before next year. Net operating loss carrybacks, they're talking about limiting those. That came in the Trump era, and in the CARES Act, they expanded those. Biden would cut those back. Estate and gift tax. This is probably one of the most important ones. This and capital gains that you're interested in. All I've been doing the last year is talking to clients about estate planning and how to move their $11.7 million per person or $23.4 million for a couple into a trust, either intentionally defective grantor trust or using a SLAT, a spousal lifetime access trust, but moving it out of their estate, because the current $11.7 million exemption, lifetime exemption per person, goes away in 2026. That's for sure. Going away, right? Now, Biden's coming in and saying, I might reduce it early, not in 2026, but do it in 2022, or maybe now, maybe retroactive beginning of this year. I don't think that's going to happen. But he's going to reduce it down to 3.5 million, which was proposed by the Obama administration in his first 2 years. You've heard that. More likely, they might bring it down to the $5 million level, which it's going to index for inflation, which is going to go to anyway in 2026. We don't know if it's going to go down to 3.5 million or 5 million, but something's coming, and it's coming soon, probably the first of 2022. So they got to do their estate planning now, this year, in the next 9 months. Great opportunity for planners like you to get out and talk to your clients and shake them up, saying you haven't done your will in 10 years. You know, your estate's grown, triple. You're now in this taxable estate situation. If it goes to 3.5 million, you're going to get whacked. We've got to take advantage and get these assets out of your estate now. And there are ways to do it, really good ways to do it, where you still have some control over the assets. We'll talk about that in a bit. The top rate going up from 40 to 45% for the estate tax under the Biden administration, and possibly eliminating the basis step up at death. That would wipe out generational wealth in families, family farms, family businesses very, very quickly. If you tax the capital gain at death, in addition to the estate tax, at an ordinary rate, because the estate's over $1 million, as we said earlier, that's going to be an ordinary rate, you're just going to wipe out the estate. Now, are they going to do that? Would Biden do that? It's in the proposal. I don't think so. But you hear hesitancy in my voice when I said I don't think they'd do it. They wouldn't do that, would they? Bernie Sanders would. Elizabeth Warren would. She'd even do a wealth tax, and that's coming up in a minute. Well, here it is right now. Here's the wealth tax from Elizabeth Warren, right? Her first order of business on the Senate Finance Committee would be to introduce legislation for a wealth tax on fortunes above $50 million. A 2-cent tax on every dollar, so 2% on wealth over $50 million. And Janet Yellen, at first in February in her confirmation hearings to become Treasury Secretary, kind of said, yeah, I don't think so. But then she came out last week on March 14th and said, well, yeah, maybe. We'll talk about it. So in addition to everything else that's going to happen in the estate tax world, this could be on the table. You'll at least see it discussed. And finally, not discussed by the Biden administration, but something that's also very possible, is something called the Strong Retirement Act of 2020, which everyone on this phone I know has heard about the Secure Act. The Secure Act came in at the end of 2019, didn't it? Only about 16 months ago. And it made significant changes, including the 10-year payout rule on inherited IRAs. Big changes in estate planning for planners like yourself. Well, there was legislation introduced in the House in August that is called Secure Act 2.0. And people don't talk about it, but I'll let you in on what I know. Secure Act 2.0 would now raise the RMD age, required minimum distribution age, from 72, which Secure Act bumped it up from 70.5 to 72. It could go up to 75, That's fine. And reduce the failure to take penalty from 50 to 25. And no RMD would be required if your client has less than 100 grand in the plan. So it makes it simpler for them. They're allowed to leave more in their retirement plan. I don't have a problem with this. I think it's great. And more catch-up provisions. Remember, you get catch-up provisions now for IRAs and 401ks over age 50, don't we? Well, now, in addition to that, it's not going to go away. But they're going to add additional catch-up provisions for those over 60. So stay tuned on that. That could happen. And finally, this is my final slide before I just talk about bullet points and planning. And it's called retroactivity risk. People ask me, well, could it be retroactive? I'm afraid. I was on the phone with one of our ESOP specialists yesterday. He had 2 clients in December purposely not make the election for a tax-free rollover into an ESOP on the sale of a family business. It's called a 1032 election. Let me get that right. 1042, I'm sorry. 1031 is like-kind exchange. 1042 is the ESOP provision for non-taxability when you sell to an ESOP. And they didn't do it because they wanted the capital gain in 2020 because they thought that the capital gain changes that Biden says he's going to make, that the Democrats are going to be retroactive to January 1. We'll see as we go through the year whether they're right or not. Now, can a tax increase be retroactive? Take a look at my second bullet point. Well, the first bullet point, there's 2 Supreme Court cases, 84 and 94. Why did 94 happen? See, the second bullet point, under Bill Clinton, I'm going to back up. I was on a seminar with the Illinois CPA Society as an attendee. And someone said, it wasn't the society, it was a different group. And somebody said, oh, Congress has never made a retroactive tax increase. They will only do it for tax decreases retroactively. And I said, wrong, you're wrong. I was yelling at my computer. August 1993, the year after I made partner at KPMG, in August 1993, in the Omnibus Budget Reconciliation Act that was passed, they made a retroactive change that went back to the first of the year, increasing the estate tax rate from 50 to 55%. End of story. Done. So could it happen? Sure. Has it happened? Yep. Happened 27 years ago. Do I think it's going to happen? I think it's unlikely. And I say that in the third bullet point. And now you're getting my personal opinions here. Don't attribute it to my bank. They know not what I say. But I'm drawing on 40 years of experience here of doing taxes for wealthy people and following the law. I just think because of the current economic environment we are in, that Vice President Biden, which at times tends to lean moderate, won't do this to people. I don't think he's going to do this to taxpayers and businesses. The corporate tax rate going up to 21 to 28%. The AMT on Amazon. And forget Amazon, they're an easy target because they make a lot of money. All those companies that, fall under the umbrella of that proposed law. So my last bullet point, Senate Finance Committee Chairman Neal made it clear he objects. So if he objects, it's probably not going to make it through. But stay tuned. Stay tuned. More is going to happen as we move forward. And finally, something I call tax bracket management, okay? For the first one is individuals, for your clients. Okay, in a period of increasing rates, you want to accelerate income. And you want to accelerate income in, let's say, the 37% year from 39.6. Again, that increase less than 10%. That's not the worst that's coming. But you're going to see more Roth conversions calculated. A lot of the wealth strategies and CFPs at my bank, and again, I'm a CFP wannabe. I'm studying for the course or for the exam right now. But they use me to do the Roth conversions and run the numbers, which I do for them. They want my tax background to do that. It's just simple Excel spreadsheets. And then you're going to see more non-qualified deferred comp and stock option plans to avoid that, pushing income into the future starting in 2022. For capital gains, going up to 39.6, if that does happen, even if it goes to 28% from 20%, which isn't even on the table, but I've heard has been discussed in the hallways of Congress as a negotiation point. Sell now, incur the tax now, do what the ESOP people did now, incur the gain now, and then and avoid the higher tax later. Sell your assets that are gains and repurchase the same or similar assets. You don't have a wash sale rule on gains, only on losses. So you don't have to worry about that. Opportunity zones, I do a lot of opportunity zone work. It's still a great opportunity for capital gains. You still get a 10% basis adjustment if you hold it for 5 years, but you're going to have to do it now because it goes away. It's got to be 5 years before the end of 2026, which is now. And if you leave it in there for more than 10 years, you permanently eliminate any gain. And if the gain's going to be taxed at 39.6 plus, meaning plus 3.8 plus state rate, don't you really want to have it completely tax-free? That's why you would put it in a no zone. IRA conversions, I mentioned, to do a lot of these calculations. That'll become more popular. By the way, Roth IRAs will become more popular if they put that 26% cap in on credits for retirement plan contributions. If you're no longer getting 37 or 39% on your contribution, you're only getting 26%, wouldn't you be more likely to do a Roth? Yes. The answer is yes, I would be. Planning for businesses tax increase. Again, some of the same concepts. 1031 like-kind exchanges, you're going to see. How do you avoid that donut hole tax that I talked about? You become an S corporation. S corporation K1s aren't subject to self-employment tax like a partnership K1 is. Now you got to take out a reasonable amount of compensation. It's not a complete freebie, but it's what I'd have your client do if I was your tax wingman on this account, or if you ever want to call me here in Naples, I would do that. I'd go S corp, and stock options as well aren't subject. Itemized deductions, I talked about some of those. I didn't mention the SALT cap being repealed because it affects the blue states so heavily. New York, New Jersey, California, Illinois, that probably will go away. It's kind of the opposite of increasing rates, right? But it helps people that itemize. And so therefore, next year's fourth quarter state tax payment, if they're not in Florida, if they're in a high tax state, make sure it rolls into 2022. Estate and gift tax, again, the big kahuna in this, it's the time bomb that's out there. The time bomb's going to go off in 2026, meaning the lifetime exemption of 11.7 is going to go down to 5. And it'll probably be 5.8 because it's indexed for inflation, 5.8, 5.9. That's going to happen for sure. So why don't you do it now with your client? Have your client give away $23.4 million now. Permanently get that out of their state. The IRS said last year, the Department of Treasury issued a ruling and said, we're not going to claw it back. If you do it now, good for you. It's a one-time opportunity. I've had a number of clients I talked to a year ago, starting in November. By December, again, they think that some of these changes could be retroactive. They wanted all the changes done. I had 2 cousins that owned a company, 400 plus million in annual revenue, give away 23.4 each to intentionally defective grantor trusts and moved it out of their estates. Now I'm going to talk to them about, that's just step 1 in planning. They're worth more than that. So we got that out. We saved them millions by doing that. Now we're going to talk about setting up GRATs, which is a whole different vehicle than what they did before, using their unified credit. The last bullet point, I talked about intelligent effective grantor trusts. You can use installment sales too and kind of claw back your planning. It's a little more complicated. Happy to go over it with anyone that wants to talk about planning. But there's so much we can do. Slats are so popular right now. I'm talking to everybody about a slat, especially if your client's only worth 20 million, 25, 30, and they don't feel comfortable in putting 23.4 million away for the kids because they said, I'm going to run out of money. Well, a slat is a spousal access trust. So if you give it to your spouse, 11.7 million, with the beneficiaries of your kids, You moved it out of your estate and you moved it out of his or her estate too. But the spouse, under the terms of the trust, can go back into the trust if they need to. If the trust says they can for maintenance or lifestyle, or they want to buy a Bentley, I don't know if you can do that. But you can go back into the trust and buy and pull out money. Your spouse can. And you can get back into the money you've already gifted away through your spouse by going into the trust. Now, you're going to ask me, can I do mirror slats? Where the husband does 11.7, the wife does 11.7. They're mirrors, and they're both moving it out of their state, but they both can get into the other's trusts. No, don't do that. The IRS doesn't like that. That's kind of a sham. But lawyers are doing it. So they'll push I know some here in Naples that are doing it. If you do a husband and wife slat, so 11.7 million each, and they can get back into the trust if they want to, if it under the provisions of the trust, they can. Have them separated by time, have them have different terms, look as different as possible, all right? And separate the time as much as possible. And lawyers are doing those transactions. So I'm not saying it's without risk, but it may work, all right? So you might be able to do 2 slats, but for sure do 1 slat, all right, for your client. Family limited partnerships. You all know what this is because you're CFPs. You all know what a grad is. I know because you're a CFP. So some of the best estate planning strategies out there are right here. And guess what? The Obama administration tried to eliminate these. There is a project at Treasury that the Trump administration tabled, which would have limited the amount of valuation discounts that you can do in a family limited partnership. Remember, when you go into a family limited partnership and you contribute your stock to the next generation, you can take a valuation discount. You can give more stock for lack of voting rights and lack of control. And that could be limited coming up. So another reason why you should do grats and flips before the end of the year, thinking that January 1 is when these changes are going to come. And don't wait till December because the estate planning lawyer is going to be too busy. They're going to be swamped come this December. They were swamped last December, some of them I talked to, in anticipation of this. Step up in basis, we've talked about. If it's repealed, you're going to find obviously a lot of people recognizing gains before death. And then I get into Illinois, which is the good and the bad and the ugly, which you don't need to hear. But I just will mention my favorite slide in Illinois. It's the estate tax. We are not leaving Illinois because of income tax. Our income tax isn't bad in Illinois. And my retirement income I get from KPMG every month is non-taxable. It's one of the few states where retirement income is not taxable. Why are we moving out of Illinois? One of the factors, the main tax factor, is the estate tax. It's $4 million. I had lunch today with one of your biggest Naples estate planning firms here in town with the managing partner, and I was explaining this to him, that in Illinois, we go to 16% immediately once you hit the $4 million level, and it's a cliff. It immediately goes to 16% for the whole thing. So if you're worth $10 million in Illinois and you die and you don't owe any federal estate tax, because remember today it's 11.7 million federal. You don't owe any federal. So you're not thinking about it. So you're going to get taxed with $1.6 million on a $10 million estate by Illinois alone. To me, that's material. $1.6 million on a $10 million estate. And the heirs are going to say, well, what do you mean we only got $8.4 million? We didn't owe any estate tax. We didn't owe any federal estate tax. So that's another reason why when people retire in the state of Illinois or New York, you see New York on here, or Massachusetts, or New Jersey, that's 16%. You see those folks coming to Florida because they got to get residency here before they die. I moved my own mother down from New York to Clearwater and made her a Florida resident 3 years before she passed. So I could avoid that tax right there. So with that, I conclude my presentation. I am so sorry, Braxton, that I went over. I apologize. We got into it, man, and this is my favorite thing to talk about.
Hey, don't you dare. I will humbly admit a couple things just real briefly. The first is I've only had two financial planning crushes in my life. One is Ken Zahn, right? The individual that trained me and prepared me for taking the CFP, and I took the exam and knocked it out the first time. And the second one is Dr. Grable, who was one of my professors at University of Georgia in the financial planning program, very well published. I have met my third. Damn. Wow.
Well,
incredible. Great, phenomenal content. There was 17 individuals that were on our call when we started. There is 16 still here.
Well, I appreciate that because I just ate into your dinner, guys, and I owe you one. There's my email and there's my cell phone number on the screen. Send me an email and let's have a cup of coffee anytime you want. I want to pick your brain because I want to pass that exam this fall too. And I need wise people like you to tell me how to study because I'm having the hardest time focusing on this. But
you have a few minutes left for
yeah, seriously, I do.
Well, if we could, I would love to open it up for questions. If you've got a question, you can feel free to put it in the chat. The questions, and really, I'd say I'd be remiss if I didn't mention that James Blakeslee is on. He is our sponsor for our event tonight. So, James, thank you so much for sponsoring both the Financial Planning Association and then, of course, our question and answer section. We're looking forward to getting to know you a little bit better. But again, if there's any questions, feel free to put them in the chat or ask them directly. You should be able to come right off mute. So one question I've got, Dan, is will the slides be made available, or is it appropriate for us to disseminate those to the group?
Yeah.
Comfortable with that? I know all of this content you work very hard on, and your goal is not just to go and attend a presentation and see your material floating around, but what do you think?
No, absolutely, Braxton. And if you want to email me, I'll send it back to you. I could send it to one person, and all of you. Molly, I sent her a copy this morning. Molly, I changed it a little bit for some things that happened this afternoon.
I saw that, yes.
So I can send it to Molly if you want. Molly, you can distribute it to the 16.
That'd be great.
Please do. I've got a couple articles. My article's called Surfing the Blue Wave. And by the way, thank you for promoting that because your very first slide of your presentation, Braxton, showed Naples Pier, and I saw the blue waves.
Yes.
And I said, it's perfect for my Surfing the Blue Wave.
Meant to be.
That's why I picked the blue background too, by the way.
Well said. Any other questions?
Call me anytime. By the way, your clients, you know this already, don't have to file till May 17th now, which is a Monday. But their quarterly estimated tax payments for the first quarter are still due April 15th. So don't miss that. The quarterly estimates, because I'm sure almost all your clients are on quarterly estimates if they're wealthy individuals, and or probably a lot of them are, and people are going to miss that because people, I myself included, if I'm making quarterly payments, usually gross up my extension payment on April 15th to cover the first quarter for the next year, and that's not going to happen this year, so people could get dinged with a penalty. It's nothing to do, that just came up yesterday, and so I've been talking about it today with people. Like I said, I love this stuff.
Sure. James, a question from you or a comment, please?
I just want to ask, I actually have a client in Illinois, so I appreciate your bringing up the 16% issue. But I assume that if you properly structure the estate so that they're domiciled in Florida, all trusted up, that 16% doesn't apply, or is
all right, James, you just threw me a softball. Thank you. The answer is almost yes. And the reason I say almost is a lot of our clients don't realize that once they move to Florida or Texas or Nevada that doesn't have an income tax and they become a non-resident in Illinois, a lot of them have retained a home in Illinois. So let's take a quick example of that. You're worth $10 million, and you have $1 million home up in Lake Forest or Barrington. So 1/10 of your net estate, of your gross estate, is in Illinois still, but you're a non-resident of Illinois. So I know, it doesn't matter. I don't own an Illinois tax. You still do. And this is how it gets calculated. That home in Illinois, they'll compute 16% on the $10 million, $1.6 million. You've avoided 90% of it because you're a Florida resident, but 10% of your assets are in Illinois, and they're going to nick you for $160,000, 1/10 of $1.6 million. So the answer is 90% good move by moving to Florida and becoming a non-resident. Now, how do you avoid that? Put that home in Illinois in an LLC. By putting it into an LLC, it becomes an intangible asset. Illinois does not tax that. So there is a solution, but it's a two-step solution.
All right. And I see Steve Frazier's on here. So the FGCU women are going to be playing in the tournament shortly here, right? I'm a UConn law school graduate, so we got a little skin in that game too. But thank you for all the details because it's really important.
For sure, yeah. Not only that, James, but you also have one of the best freshman players in the history of women's basketball. So I think you guys are going to do just fine in that tournament. Well said. And thank you for your comments and questions. Any other questions? Any other comments? One thing I'll mention is, again, I took some of the comments that were provided, and again, the sentiment by Dan, and it really reminds you, and it's very refreshing for you to take note of the fact that, like, look, we're nonpartisan. Like, at the end of the day, we're sitting across from a client, and we're helping them to make decisions about their financial life, and it's our job to provide them with the information that they need to make an informed decision. And if it is to avoid estate tax, if it is to make sure that we're avoiding other types of tax for them, it's incumbent upon us and our fiduciary responsibility to provide that. So I think Dan did a phenomenal job in giving us that, again, very content-rich presentation, and we're very excited to hopefully have him join our body. Dan, the Beast Rahill.
Well, I welcome to meet you all in person and to join your group. Like I said, I'm paying my dues now to the Illinois chapter. I want to move it over to you. You're more fun.
Yeah.
Molly, show me how I can do that. Where do I write the check?
It's easy. Anthony just did it last week, so I will send you instructions on how to do that.
Send it.
We'll all meet up at Celebration Park.
Yes. Yeah. I'll ride my bike.
There we go.
Hey, we should have our live meeting there. I love the food trucks.
That was a suggestion of our treasurer, who's right over there, Andy Strand. Thank you, Andy, for that suggestion. Great suggestion. Wonderful presentation. Thank you all so much for your participation. We will be back in live with you hopefully shortly. Watch the website, watch your email, and again, thank you all so much for attending this evening. Dan, phenomenal job.
Thanks, everyone.
Dan.
Thank you.
Have a good night.
Night. Woo, I went a half hour long.
Well, you had to really work hard on that one.
Oh. Nina was on the whole time, I could tell.